So what is capitalization? Capitalization is nothing but showing a particular, like, expenditure in the asset side. Thing is nothing but showing the expenses in asset side of balance sheet. And expensing is nothing but showing the expense in the profit or loss account, or SOPL, statement of profit or loss. Okay. See, generally what happens, like whenever you purchase a particular asset, you initially, record them as an asset in the balance sheet. Everyone knows that, right? So we'll read out some points. When a firm makes an expenditure, it can either capitalize the cost as an asset on the balance sheet or expense the cost in the income statement in the period incurred. With this, it is very clear for you to understand. Capitalizing is nothing but the process of recording the asset in the asset side of balance sheet. So capitalize the cost of the asset on the asset side of balance sheet, and expensing is nothing but writing it in the income statement. Okay. As a general rule, an expenditure that is expected to provide a future economic benefit over multiple accounting periods is capitalized. That means any expenditure which you are incurring. And I will tell you certain points. Let's say you purchased a plant and machinery. When you purchase a plant and machinery, here what happens? This particular plant and machinery is purchased once during the initial, during the inception. First of all, you purchase that at once. Second point, you purchase them during the inception. Third, it is a non-recurring nature expense. Fourth is it will provide you future economic benefits over the lifetime. That's what they said. An expenditure that is capitalized is nothing but initially recorded as an asset on the balance sheet at cost, which is typically its fair value at acquisition. Yes, when you purchased an asset, you made some payment to buy that asset. So when you purchased that asset and you made some payment to buy that asset, that is nothing but the market value as on that day, or fair value as on that day. Okay, for you it is cost, but for the other person it is the selling price or the fair market value what they want to collect. Okay, so it is nothing but the cost what you incurred to buy that asset is nothing but equivalent to the fair value of that asset on that day, plus you have spent some expenses to bring that asset to your factory premise, or you have spend some expenses for you to make that asset ready for use. Like if you bring plant and all, also that one. Okay. So here the points where, as a general rule, an expenditure that is expected to provide future economic benefit over multiple accounting periods is capitalized. I already explained you. If the future economic benefit is unlikely or highly uncertain, the expenditure is expensed in the period incurred. So something which can give you economic benefits can be put in the can be shown in the asset side of balance sheet. If not, then you have to show in the P&L. So, if I take property, plant and equipment, it gives economic benefits. So I'll capitalize it in the first year, and then every year it will be expensed via depreciation. Intangible assets via amortization, mining asset via depletion. Okay. So that will, be the portion of the asset every year which we have allocated like over its lifetime, because we want to reduce the value of asset, because one day it will become a scrap or zero value it will have. So alternatively, if an expenditure is immediately expensed, current period pre-tax income is reduced by amount of expenditure. Yes. So if you are incurring an expense, that will reduce your incomes. Okay. So everything is understood. Let's go forward. Now, once the asset is capitalized, that means shown in the asset side of balance sheet, some subsequent expenditure related to that asset that provide more future economic benefits like rebuilding the asset, improvement of asset, installation of asset, overhaul of asset, etc. should be capitalized. Again, non-recurring nature, spend only once, giving economic benefits should be capitalized. But recurring nature happening in regular intervals, okay, and making the asset to sustain. So subsequent usefulness of asset. Okay, if you don't spend this, the asset will not be that useful for you, or it will give you great service, like regular maintenance, etc. are expensed when. This is the topic which we have discussed right now. Please go through this once. Have a reading, then we'll go for the question. Fast. Okay. Would correspond or new equipment to be used in its manufacturing plant. The cost of the equipment is 2,50,000 less freight charges and 12,000 of taxes. Okay. Again, they paid 10,000 installation and 7,500 to train employees for the use of equipment. See, I'm purchasing manufacturing plant. It will give me economic benefits. I will add all those expenses, which will be very important for me to bring that asset to my, factory premise. Will I add it? Yes. Yes. That will be again my asset. Okay. Asset cost. So, and like, installation, yes, I will add. Training given to employees for the use of equipment is not my asset which I need to is not my expense I need to capitalize, because this will not give me economic benefits. This will give economic benefits for my employees. Okay. And repairs and maintenance, is to be expensed because this happen in regular intervals. At the end of 5 years, North Life extended the life of asset by rebuilding the equipment and motors at 85,000 cost. Again, I'm rebuilding the asset for better usage. So what I need to capitalize and what I need to expense. Need not worry. Let us do this. 2,50,000 I will capitalize. And of course, I will capitalize 10,000, the installation. Of course, I will capitalize 85,000. Okay, this, see, one thing you would not 5,000 because cost of equipment is 2,50,000. That includes the 5,000 freight and 12,000 of taxes. So these two are a part of this. That means 17,000 is all inclusive in this. So we will not take this two again. They will give you questions to confuse. So we took the asset cost, which includes the freight charges and taxes. We took the installation. We took the like cost for rebuilding. Capitalized. What is expense? 35,000 repairs and maintenance is expense, and training for staff employees is expensed. Okay. So I think we have done this. Yes. Please have a look at this. Now, impact of capitalization on financial statements. What happens if you capitalize certain expenses, and what is the impact of that on the financial statement? So Chair Limited was incorporated at the start of the year with issuance of 40,000 pounds of shares paid in full capital. Okay. The company immediately purchased new equipment to be used in the production process. The machinery cost 12,000 pounds. Estimated life is 4 years, no scrap value. So depreciation would be 3,000 per annum. Straight line depreciation, right? Original cost of the asset minus scrap value whole divided by estimated useful life of asset. This is the formula for annual depreciation. Equipment is depreciated using straight line methodology, as they have clearly mentioned and we have done in the accounts, and we will assume the accounting depreciation is tax deductible in that as deduction. Chair has no other assets and liabilities except cash and PPE. Assume Chair has revenue of 30,000 pounds per year and an operating profit margin of 40% before the impact of equipment purchase. Chair is subjected to 30% tax rate and pays no dividends. Compare and contrast the impact on financial statement if the cost of equipment is capitalized versus expense. That means one, we will see whether if it is capitalized, what happens, and when we will see when it is expense, what happens. Let's go to the income statement. This is revenue. 4 years, right? The asset will be utilized for 4 years. Revenue is 30,000. And your first, what you're doing is you're capitalizing the asset. Capitalizing the asset is nothing but writing this in the asset side of balance sheet. What happens if you write the asset in the asset side of balance sheet? Every year you have to show the depreciation expense. Okay, because the asset is shown in the balance sheet, but every year it will be expensed, right, via depreciation. So first, when you bought this asset, you put it in the balance sheet. Okay, so revenue is 30,000. Operating profit is 40% of this, that is 12,000. Depreciation, you have capitalized the asset, right? Put in the balance sheet. So the asset would be depreciated every year and its expense will be shown in the P&L. So 3,000 income before tax. Tax you have calculated, and then it is net income. Then again 30,000, then profit, then depreciation, PBT, tax, PAT. Every year this is going on. Okay. Now we will now expense the income, expense this particular asset. Expensing is nothing but you are writing the asset in the income statement or statement of profit or loss. That means you are showing that equipment cost as an expense. So revenue, operating profit, 40% of this, and the equipment expenses taken. These two will nullify. It will become 0, 0, 0. If you put the equipment in the asset in the income statement, what I said, if you put the asset cost in the income statement or you expense the asset cost in the income statement, depreciation is not required to be calculated. So revenue, operating profit, no depreciation, income before tax, tax, PAT. Now this will be going on every year. What you kind of understand is, if you capitalize the asset, you show its expense evenly over every year. But when you expense the asset, you show its expense only in the first year, and rest of the years no expense is shown. So what you see is the income is every year same. Here the income in the first year is almost 0, but other years the income is more than the capitalization. Okay, please see this and check this. We'll move forward. Now, capitalization spreads the expense of the equipment in the income statement over the life of the asset. Expensing results in the full cost of the equipment passing through the income statement in the first year, which I mentioned, but none of the subsequent years. I already told you. In turn, this causes net income to be lower in the first year. So if you expense the asset, your net income is zero, but in the coming years, your net income is more. But in case of capitalization, your net income is even every year. Okay. Okay, capitalization results in loss in less volatility of earnings when compared to expensing. Yes, your incomes are always stable. There is no volatility, no change. Here the income is volatile. First it is almost zero and then it is 8,400. Just a second. So balance sheet capitalization of equipment cost. So this is the cash and you have cash, okay? And property, plant and equipment, first year you have 12,000 the asset value, 3,000 is depreciation, then 9,000 is your asset value. Every year 3,000 will be deducted and the fourth year asset will be zero, okay? This is your share capital which is given in the question, and retained earnings, you will be transferring the profit to retained earnings, okay? What is your profit? 6,000. Then now coming to expensing part. Expensing of equipment. So first we take the cash and like you don't write anything if you expense. Doesn't come under balance sheet. And share capital and retained earnings is zero. Already we see, right? When we expense, the retained earnings is zero because net income is zero first year. Then cash second year 48,400. What happens? See, when like you are expensing, okay, you must have seen that every year your cash balance is also increasing. How the cash balance is increasing? 37,300 plus 6,300, 6,000. Just a second. What was the profit first year? Just a second. Cash. From where did they bring this? No, from where did they get this cash balance. Just a second. Maybe if I'm not wrong, my share capital is 40,000. My retained earnings is 6,300. 46,300 is my equity. From that, if I remove property, plant and equipment, I get cash. Because total of assets should be equal to total of liabilities, right? I'll check out whether there's a cash balance given or not. See, revenue can be cash revenue, can be credit revenue. So there's no mention. Okay. So it is 33,700, right? 37,300. Yeah. Actually, they haven't given any detail as such. So I'll go with this narrative that I know what is my share capital. It is 40,000. Okay. And I know my retained earnings and my total of equity is this. From that, if I remove property, plant and equipment first year, I get the cash balance. Okay. And then second year, my retained earnings get added. This is the case. And then if I remove 6,000, I get my cash. Prithvi, are you understanding what I'm saying? Third year, again, my retained earnings get added to this. Retained earnings of 6,300, I get this balance. 40,000 plus this is 58,900 minus the property, plant and equipment 3,000 after depreciation. Okay. I get my cash balance. Again, 65,200 retained earnings of all the 4 years and then added up, I get this. And then from that, I remove 0, I get 65,200. Okay. In the same way, here 40,000, then again, I know my retained earnings is 8,400, 48,400, and this is my property, plant, equipment 0, my cash is this. Again, the same thing goes there, again, the same thing goes there. So now we will go for the cash flow statement, right? So you can check. We can check that my cash balance in case of capitalize, we will see all the assets. We will see that when we capitalize the property, plant and equipment, it was having higher value and slowly, steadily, its value got decreased and become 0. Cash balance is increasing every year. My equity is also increasing. Okay, my retained earnings is increasing. And we will see what they have mentioned here. In the earlier years, total assets and equity are higher. Yes. If the firm capitalizes the cost, because earlier years we write the entire value of the asset and slowly, steadily it will get depreciated and the value will decrease. Okay. So this is understood. Equity will be higher because, you show very less expenses when you capitalize because you only show 3,000 as your depreciation and the retained earnings is 6,300. Next year also 3,000 and your accumulated retained earnings is increasing every year. Okay. And it is increasing your equity balances. Okay. Now cash flow statement. We know operating cash flow. We have to find out this operating cash flow. We have done cash flow statements, right? So we know how to find out. We will take net income. So net income is 6,300 and to that we will add depreciation of 3,000. Non-cash expense will get 9,300. Okay, this is understood. And then we have purchased some what is investing cash flow? What did we purchase? What data they have given to us? Yeah, equipment we have purchased. So purchase of equipment is a investing cash flow. and we have arranged capital for our business, so 40,000. Second year investment happens only once, capital is raised only once. Okay, and this is not there, this is not there, this is not, this all are not there, and this is the case when you see the cash flow when you prepare the cash flow statement, and when the equipment is capitalized, that means shown in the asset side of balance sheet. But we will see when it is expensed, we can state operating cash flow as net income plus, so that is okay. And the only non-cash charge in this example is depreciation. Working capital investment is assumed to be zero in this example because nothing we are not using any elements of working capital, right? Inventory or receivables, anything like that. So opening cash, let's say zero, and we saw the change in cash from like in the first year you had nothing, right? You had nothing in your cash balance, and you see a cash balance of 37,300. So closing cash, again this becomes opening, and next year you add 9,300, this becomes closing, again opening, added, closing, again opening, added, closing. Okay, if we expense the equipment, what happens? So operating cash flow, just a second, just a second, just a second. Yeah, so now operating cash flow is zero when we expense because when in the case of expensing, net income was zero, depreciation was zero. Okay, financing cash flow was 40,000, and then this is the you have nothing here, and your closing cash balance is 40. Again next year's 8,400, and depreciation is zero, right? Because we don't show depreciation when we expense. So 8,400 and then 40 opening balance plus this addition and then closing. So this will be going on every year. Okay. So Prithvi, we will take up the next topic tomorrow. We will take the ratios part. Are you, hello, are you hearing? Yeah. Yeah. So we will take up this part tomorrow, capitalization versus expensing and the impact on all these ratios, total asset turnover, net profit margin, ROE, and also all this, what is increasing, what is decreasing, what is higher and what is lower. We will take this, we will do the capitalization interest topic also, and R&D topic also. All these things, whatever are there, right, we will do. Okay, and just a second. Yeah, so till wherever we have, where we started from EPS. So from there we will finish till here, okay, and then only the first topic will be there which we did in the academy. Fine. Sure. Okay, okay, good night.